The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners, EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady. And this is our hour to talk taxes. And look, you got 25 days, if you count today, till April the 18th. That's the end of it. And according to the IRS, a lot of people are filing later. So if you are confused, you got some answers here today. Give us a call at 803-0930, 803-0930, star 930 on a cell phone. And I have Tiffany Fabian in studio with me. Hey, Tiff.
Hey there, Esther. How are you doing?
Good. It's wonderful to get out of the pit, so to speak,
right? It is. It certainly is. I always look forward to Saturday about this time for many reasons, but that is certainly one of them.
Okay, so you know what? I know we have some calls holding. 803-0930, 803-0930, star 930 on the cell phone. But what I want to talk about today, confusing items that confuse people, and one of them is Obamacare. We had somebody that came in the other day. I just happened to go into Chris's office, and a gentleman said, well, I just don't want to deal with the ACA part of the tax return. Just leave it blank. And we said, no, we have to answer it, because and yesterday, since the Affordable Care Act was defeated under Trump, the Affordable Care Act is still part of the law of the land. Now, I don't know what's going to mean when Trump had signed that to hold people harmless, but it is the law of the land. So one of the things is, if you don't have health insurance, there are a number of exceptions to penalty. Right, Tiff?
That's right. There's lots of exceptions, and we've been utilizing a lot of them because they fit. There's a lot of them, and so it's vast. And
all right, so one of them is hardship.
At.
The other one is that your income is under the poverty level. You would then qualify for Medicaid in New York State. Many people, when I see tax returns, many people that haven't gotten health insurance actually could have gotten it for free.
Yep, that's right. Or they might have qualified for the essential plan, but yep, that's precisely
which is
correct.
$20 a month. So here's the thing. Before you make that decision, and I find that that's what happens a lot of times with people, is that they already pre-decide there's nothing that can be done, and so they don't do anything. One of the great things is we have two navigators that are right in our corporate headquarters, Tim Eliason and Karen O'Brien, and they can help you if you don't have health insurance. And they will find you, and we don't, what do we charge for this? Nothing, right?
Nothing.
We get nothing for it.
I can think of, I do a couple of clients, and they're in Rochester, and they make decent money, but when they pay for all their bills, they didn't have enough to fit it into their budget. And so there's an exception that you can fill out that says, if you add up all my bills, I just don't have enough to carry health insurance. And so that's what they're going to do. They're filling out the paperwork, and we're getting it in. Right.
And then the other thing is, if you are somebody that got your insurance through the marketplace, through the New York State of Health, they're going to send you a 1095A form, and many of those people got subsidies. You have to reconcile the subsidy that you got against your actual taxes as reported on your 2016 return. Now, if you got too big of a subsidy, you're going to end up having to pay part of that subsidy back. If you got too little of a subsidy, then you're going to qualify for the premium tax credit, which means they're paying you.
And something really cool, there's some people that have gotten it through the marketplace, and we'll have them put money with their agreement, of course, into an IRA, and that even lowers their income more, so they get more of a net premium tax credit.
That's exactly right. So there's all kinds of things that you can do even now when you're preparing your tax return. I'm Esther Gulius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on the cell phone. We have Jack, who's been holding. Mr. Jack, how can we help you?
Hello there. I have a question about New York State pensions and deferred compensation 457.
Okay.
As far as I know, if you were a state employee, your whole pension is still tax exempt, right?
That's correct.
Oh.
in New York.
It just doesn't. It's not.
But it's only on New York. Tiffany's right. It's tax exempt on New York only. But on the federal, you pay taxes.
Right. I understand that.
Okay.
Okay. Now, my question concerns mostly the 457 plan, which is, first of all, on the federal tax form, you don't report that under the IRA distribution. This is minimum distributions we're talking about now, right? On the federal tax form, you don't report it on IRA distributions.
That's right.
You combine it together with your pensions, right?
That's correct.
Okay. And as a result, when you do that, if you combine the both of them, and when you go, now I'm talking the state tax form now, when you go to the state tax form, it says that you're supposed to take off pensions. So what I'm trying to say is,
well, let me tell you what's supposed to happen. All of your New York State pension is going to be tax-free.
57, right?
All of your New York State pension is going to be tax-free. The non-New York State pension, the one that you contributed to, you can take the first $20,000 off as a deduction. So there's going to be up to $20,000 deduction, and there's also going to be the full deductibility on your for New York State.
Oh, well, I guess I'm a little confused. So my actual pension, that's tax exempt on the state tax form, right?
That's right. And the first $20,000 of your non-New York State pension is also an exclusion. So how much did you take out on your 457?
Right. Okay.
How much did you take out?
$16,000.
All right, so that's all tax-free too.
Okay, so then, all right. You've answered my questions. Thanks.
Okay, Jack. Thanks for calling.
All righty. Bye.
I'm Esther Galias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. And we're talking about confusing issues today, and I know we have people holding. Sale of stock is really confusing to people, right, Tiff?
Yeah, absolutely. It became even more cumbersome about 4 or 5 years ago.
Why? Tell them why.
Because the 8949 became around, and so then they talked about covered and not covered, and you had to align and spell out where the stocks, if they were covered, if they were not covered, if the basis was reported, if the basis wasn't reported to the IRS, and you really had to spell out all those stock sales.
Right, and so basically when you're doing your Schedule D with your stock sales, if it's a covered transaction, it means that if it's a short-term covered transaction, it means that the stockbroker took the basis and is watching it for you. So they're providing that information and they send it to the Internal Revenue Service, and that's called an A. If it was a non-covered transaction that they didn't report to the Internal Revenue Service and it's short-term, it's coded a B. If it's a covered, they reported it to the Internal Revenue Service and kept track of the basis, that's a D. And if it's a non-covered long-term transaction and they kept track of the basis but didn't report it to the IRS, that's an E. And an X means nobody knows, right? And it's up to you to determine the basis. But that's what is required when you're preparing your capital asset, sale of capital assets. So that all goes on the Schedule D. And you want to make sure you use the Schedule D because that's special tax treatment. If you're in the 15% bracket or lower, you actually sell stocks and it doesn't cost you anything. It's 0%.
Right.
On the federal, on New York State, all the bets are off.
Not to mention your tax can be computed using that Schedule D worksheet on page 2 of the 1040.
That's right. And the other thing is, take a look when you're looking at your stock portfolio 1099 form that they send you at the end of the year. If you see that they sold, and I know a lot of people think, I didn't sell it, okay. But if it was traded and there's no cost basis, make sure you call your broker. I had a lady the other day who sold $29,000 worth of stock. She was just happy as a little clam. She's sitting there, I'm doing her tax return. So I said to her, what did you pay for the stock? I don't know what I paid for it. And I said, well, call your broker. And she said, just leave it like it is. I said, we need to call your broker. It was going to cost her like $4,000 in taxes if she didn't call her broker to find out what the basis was. When she finally called her broker, it was actually a loss, not a gain at all.
Wow.
And so you want to make sure you ask your stockbroker what you paid for the stock if they don't give you the basis. Don't just assume that everything on that 1099 form is correct.
That's right.
Right?
And the thing is, if you don't put it on your tax return, the IRS will send you a nasty gram, and they'll put the basis as zero.
Right, and that means it'll be fully taxable.
Mm-hmm.
Well, why don't we go back? Well, you know what? We'll take a short break. I know we got Mandy and Sherry, and who else is holding? Yeah, that's Mandy and Sherry holding.
Bill.
We're going to take a short, and Bill, and we're going to take a short break. We'll be back on the other side with your questions. 8030930, 8030930, star 930 on a cell phone. We'll see you in a minute. Hey, this is Mello Estragoulias from EG Tax, and we're here to help you with your taxes. Hey, we only got like 25 days left, including today, till the big day, April the 18th, and we certainly want to help you. And whether you haven't gotten your refund, you're wondering where the heck it is, if you're struggling with those Schedule Ds and those broker statements, or you're self-employed, whatever the problem, give us a call here in studio, 8030930, 8030930, star 930 on your cell phone. And Tiffany, why don't we talk to Sherry first?
Yeah.
Hey, Sherry.
Whoop. Hello?
Hey, Sherry.
Yes, that's me.
Hi, how can we help you?
Hi. Have a question. We last year, my husband we were older, but not quite old enough to retirement. Had lost his job, and we found out that we were eligible for Medicaid and didn't realize that. Said many people don't even know that they are, and I heard you mentioning something about that earlier. But now this year, we'll be able to start collect our Social Security.
Right.
I don't think we're going to be eligible for that anymore after Social Security, and I was wondering about that essential plan that you said. Would we possibly be eligible for that? Because we're not eligible for Medicare yet till 65.
I went and looked online for a client yesterday, and I think it's below $32,000 a year. And you can look, you can go to New York State Marketplace, and I think it's $32,000 a year. That's with Social Security.
Okay.
So yes, you would be able to qualify
If
your income was lower. Yeah.
Right.
Right.
But again, why don't you give our team a call if you need help, because, you know, that's
like
what their
whizzes.
job is. They will call the state on your behalf and try to get you plugged into the least expensive plan.
Right. Because that's what I thought. Once you get into after that, I would go into the marketplace.
Right.
Right, for a couple of years till I'm eligible for Medicare.
That's exactly right. But again, we have Karen and Tim at the office. They will help you. But like Tiffany says, go to the New York State of Health and see if you don't qualify for the essential plan.
Okay, and who are the two people at your office to speak with, you said?
Tim Eliason or Karen O'Brien.
Okay.
And you'd call 632-7886.
Okay.
Okay. Thanks
Thanks,
very much,
Sherry.
Sherry.
I'm Estragoulias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. We have Mr. Bill on line 3. Hey, Bill, how can we help you?
Hey, I'm just calling in regards to my wife and I are very low income. We have no deductions for long, like the long forms, I guess. So it's simple tax. Is that something we could just stop into any of your offices and file them real quick?
Oh, sure. Yeah, I mean, you can call and make an appointment at any of the offices, but just stop in. Sure. We're there 9 to 9 Monday through Friday, 9 to 5 on Saturday. We have 2 mall offices that are open on Sunday, one at the McKinley Mall and the other one at the Niagara Factory Outlet. So, yeah, absolutely.
Because I know last year I had a CPA that did some work for me over a number of years, but no, because of a financial situation, a bankruptcy, and some other things, our income, but our assets is the problem. We have no assets as far as that. So he did a simple forms for me, and it was almost $250.
Well, I think you'll find us to be well under 100. So
that's what
we certainly will be very happy to help you and honored to do so.
And what about carving out? Would you be better off after the 15th to carve out some time for financial, to look at a financial?
that's part of what we do too. We don't charge to do budgets and to sit down and help people kind of navigate their finances. There's no charge. After the 18th of April, you can call our corporate office, and we're all there to help you with your finances. So, and we don't sell anything. So we're not selling any stock. We're not selling any insurance. We're there to look at your finances and make some suggestions so that you can tax plan or financial plan, and we're happy to help you.
And I noticed you live in Williamsville. If you go to the one on Transit Road in Williamsville, Dana works there, and Pravin. Dana is an enrolled agent, and she's great, and so she could help you to look at last year's returns or whatever financials. I think she could do it right away, Bill.
Okay, thanks so much. I appreciate it.
All right, thanks, Bill.
Okay.
Much luck. I mean, I will tell you, a lot of people have had financial problems, and I know there's probably a lot of people that are listening who have credit card debt and they're not happy about it. Bankruptcy is meant to be protection. It's in the law because it's unlike England when you became a bondservant until your debt was paid off. Bankruptcy gives you an opportunity to get out from under that debt if you qualify, and it really is a means to an end. A lot of people say to me, "Oh, I don't want to go bankrupt because it's going to ruin my credit." I don't know if you know it, but if you have a lot of debt, your credit's already ruined. And so you're going to walk around with that bad debt hanging on you like a dead body until you are able to get out from under. And sometimes the only way to get out from under is to do a bankruptcy. And I will tell you, I don't think you should be ashamed of it. It's there to give you a fresh start. That's really exactly what it is, a fresh start. And
you've always taught me there's no, like you said, there's no debtor's prison here,
No, and it's meant to give you a fresh start. So unless you know of some miracle that's going to pay off your debt, sometimes the only way you can get out from under is to learn a lesson, rip up those charge cards, and do a bankruptcy. Right. All right, let's go back to the phones. 8030930, 8030930, star 930 on the cell phone, and we're going to go to Mandy. Hey, Mandy, how can we help you?
Hello. I had shares of First Niagara stock, and they were taken over by KeyCorp.
Sure.
And part of the payout transferred some of the shares to KeyBank, and then I got a brokerage form for the cash portion. So when I was doing the taxes and I looked, we bought the shares 2 separate times at $10 a share. And it shows on the form 500-something shares, and the payout was a little over 1,000. So if I used that cost basis of $10 per share, I would show a loss of 5,000.
But that's really not how it happened, though. Isn't it correct that part of the money was spun off in cash and the rest was spun off in new KeyCorp stock?
Yes.
All right. Do you know what percentage was given to you in Key stock?
They have on the 1099B, it shows a partial of 0.056, or would I have to? It says 567.
Okay, so what they're saying is that whatever percentage of total went to cash, that's whatever percentage would be in your cost basis, and then the rest of it would become the new cost basis for Key. So it just becomes a mathematical equation where you're going to say, let's just use the 1,000. So 560 then would be your basis for your First Niagara stock, and the balance of it, 440, would become the cost basis in your Key stock.
Okay.
Okay?
All right. I didn't think that was correct to read it that way because...
Yeah, because then what would happen is if it did it that way, then there would be no basis in the Key stock.
And this is a good example of what code she's going to use on the 8949. Esther, we've done a lot of these. What code does she use?
Well, that would be an X because nothing is provided.
Right.
Right.
But it's long term.
Right.
Because you didn't just buy the First Niagara stock last year, right?
No.
Yeah, so
For some-
that would be an X. It would be long term, and then the difference between what your cost basis was and what you sold it for is going to be a long term capital gain.
Very good.
All right.
Thank you very much.
All right. Thanks a lot. I'm Esther Golias, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone. Wanted to also talk about 1099 forms, Tiff. Those can be completely, well, there's all different kinds of 1099 forms, right?
Yeah.
But especially if you got non-employee compensation, people don't know what to do with that. And so what they do many times is they put it on line 21, but that's not correct, right?
Nope, it should go on Schedule C, subject to self-employment tax.
Right. So when it's non-employee compensation, it means that you got compensated and you're not an employee, so that's why you didn't get a W-2. So you are self-employed. And so when you put it on a Schedule C, you get to reduce it by any expenses that you had to make the money. And then on the bottom line, you have to pay income tax and FICA.
That's right. That's right. So, for instance, I did somebody yesterday who got a 1099 because she's a photographer, and she received a 1099. And so we put it on the Schedule C, and we took her expenses, her mileage, that she traveled to different shoots. She buys props. She
might have an office
camera,
and home,
yep,
right?
Yep. So there was a whole lot of things, and bookkeeping is really critical in that type of situation.
It really is. Now, another time, like for instance, car salespeople, many times get a 1099, but theirs is under other, as opposed to non-employee compensation. So many times they're getting a bonus based upon spiffs. That is not subject to FICA.
That's right. And so that goes on line 21, like you said.
And that goes on line 21 as a spiff, right?
Right.
I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930. We're breaking for the news. We'll see you on the other side. Hey, this is the tax lady, and this is our time to talk taxes. I'm from EG Tax. We have 33 area offices to serve you. They're open 9 to 9 Monday through Friday, 9 to 5 today. Tomorrow we have 2 area offices that are open in the malls. We kind of think that Sunday is a sacred day, not to open offices, but we comply with mall hours in the McKinley Mall and the Niagara Factory Outlet Mall. So. Hey, Tiff, should we talk about, by the way, 8030930, 8030930, star 930 on a cell phone. Let's talk about Social Security. I know a lot of times people get really confused about Social Security and how much you can make before you have to pay it back and when that starts and is it really taxable, and that can be really, really confusing. So the first leg of Social Security would be somebody that's available to get it at age 62. If that's the case, then you're limited in the amount of wages you can make before you have to start paying back the Social Security Administration because you made too much in wages. But the taxability aspect is really a horse of a different color altogether, right?
That's right. That's right. And so you want to add up all your other income plus half of your Social Security, and whatever that figure is, you divide it by 2, right, Esther?
Right. Well, half of the excess over the 32,000 or 25 is half taxable. But the thing is, many people don't realize that, number one, between the ages of 62 and 66, when you have regular, normal retirement, you can end up, if you make more than, I think it's $17,400, you can end up paying Social Security back $1 for every $2 over that figure, and have it be taxable as well. So those are part of the tax planning aspects that you want to make sure that you're aware of, so that you know how this affects you. I always suggest that people take if it's going to be taxable, that they either do the lower tier or the 15% tier in withholding to cover the taxability of the Social Security.
Yeah, and then there's so many people who collect Social Security, and sometimes they'll go to the casino, and if you have gambling winnings, that for that year makes more of your Social Security taxable, and that always poses
even
a
though
problem.
you didn't make any more. And that's what's so weird is it's not like you've made any more money, it's just more taxable. So you want to be very careful, and that's where if you did work, using the IRA to your best advantage up till April the 18th can lower that adjusted gross income, making your Social Security less taxable.
That's right.
Right?
Yep.
Okay, I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on the cell phone. We got our buddy from Atlanta on the phone, Larry. Hey, Larry, how can we help you, sir?
Hey, darling. Thank you so much, Esther. Esther, I've got a couple of very quick para points. One, Tiffany, I got your voicemail.
Thank you.
About the extensions. Thank you so much. Number two, dear, I want you to get your sleep because I worry about my EG Tax family very much. I really do. Three, Esther, I emailed Mom recently, and I tell her I think she's cute. And then please, and then lastly, Tiffany, email me my charge. Will you charge me to do my taxes so I know what to expect?
Sure. Yeah, and I tried to email you back, Larry, but it got bounced back. I don't know if your email capacity was full or something like that, but it said that it was bounced back. And so it should be similar to whatever Chris charged you last year. That's, yeah.
Probably is. But,
yeah.
Johnny, that's all for now. Thank you.
All
right,
Larry,
thanks,
Larry, how was your trip?
Oh my God, it was fantastic. I'm still suffering from jet lag. I'm like 25 hours a day right now.
Oh my gosh.
But it is what it is, right? But
yeah. And should I tell Chris, are you getting all your stuff together?
Oh, positively. I'm just about there. Positively.
Okay.
All right. Thanks, Larry. Have a good day.
Bye-bye, y'all.
All right. Thank you. See, goodbye, y'all. That's what they say down south. We say you guys. They say y'all.
Y'all.
Right?
Yes. Y'all.
All right. I'm Esther Golias, the tax lady, 803-0930, 803-0930, star 930 on the cell phone. Let's talk about gifting. A lot of times when people are starting to get a little older, they worry about their number one asset, which is usually their home. And so what they do is sometimes they just sign the home over to their children because they're worried about the 5-year look back in the event that they become hospital or put into a nursing home. Now, there's a good way to do it and a not so good way to do it. I would suggest you use a life estate if you're going to gift your house to your children, because that means that you still retain control. The taxes still come in your name. All of the exclusions and STAR programs that you had originally are retained, and you get to maintain your ability to stay in the house for as long as you want to. Okay, and then upon in the eventuality of your death, the children, it goes through the estate, the children get a stepped up basis and they don't have to pay the capital gains on the house. If you just gift the house, then the basis goes back to the original cost that you paid for the house, whether it be 30, 40, 20, whatever it was. And if it's now worth $150,000, the kids end up paying a big capital gain. So that's what I would suggest that you look at doing, as opposed to just gifting the house outright.
Yeah, and there's so many people, they don't understand that, and so they'll gift the kids their house, and then when they sell it, then they're surprised by what happens. They have to go back to that original basis. And
that's right, and it can
be
real, right? Yeah. It can be quite costly. So it's just really a trip to the lawyer to do the life estate. And it's not extremely expensive, but I will tell you, in the long run, it's probably the best thing that you can do.
Yeah.
All right. Why don't we go back to the phones, and we have Mary from Akron on the phone. Hey, Mary, how can we help you?
Hello?
Hi, Mary.
Hi. Yes, we haven't done our taxes yet, but I'm just wondering if because I went to full-time from part-time, and I'm just wondering if we end up owing something, can I contribute more to my retirement so that I won't owe something, and when does that have to be done by?
All right. Well, you can't really contribute to your retirement, but you can contribute to your to an IRA, possibly, if you don't have a qualified plan at work and your income is not too high. May I ask what do you got? You obviously have a retirement plan at work, right?
Yes. I also have a separate IRA plan.
All right. So may I ask what you and your husband make approximately?
Usually it's just a little under 100. I think this year it's going to be a little over 100.
Okay, so you'd still be able, it sounds like you'd still be able to contribute to an IRA.
Mm-hmm.
So because of phase out, where if you have a qualified pension plan, you're not at that phase out limit, so you'd be able to contribute to an IRA. So that's what I would do. So it's something you can just tax plan when you're there. When you're doing your tax return, take a look at how much you save by putting money into the IRA. And the other thing is, if you were self-employed, you could put money into an SEP, and if you didn't have an HSA, you could also possibly contribute to an HSA. So those are like several options that are available to you.
Okay, and we could do that. We have
up till April the 15th, April the 18th.
Okay, all right. Thank you.
All right, thanks, Mary.
Okay, bye-bye.
I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. The other day I had somebody come in, Tiff, and on the 1098T, the tuition that was charged was $0, and the amount of scholarship was $18,000.
Oh.
So what did that mean?
That means they don't get the college credit, and then you want to know what that scholarship money was derived from. Was it TAP or Pell?
No, this was a scholarship.
Okay, so then there's an issue of the
So
taxability.
it's income,
yeah,
right?
Yeah.
So, but that's what happened. That's the way they do things. They front end load your college. So the first year the kid goes to school in September. Excuse me. They also include January, the spring semester.
Yeah,
so that's front end loaded. Then the
and
next
there's
year
a
front end
box
loaded.
on that 1098T which will indicate that they've front ended it, as Esther said.
Right. So the thing is, what he ended up with is they had given him the credit the year before. He took the credit, and now, of course, he didn't like that his child had to pay the taxes on the scholarship. But there's nothing you can do.
Nope. It's
So
good
that's
that
another
it's
thing.
good that
That's
they got the
another
scholarship.
confusing thing,
That is very confusing.
right?
Another really confusing thing is if you're the custodial parent and you lose the child for this year, don't forget that you possibly can get earned income credit if you're the custodial parent and you don't get to claim your kid for the year.
You're talking about the New York State.
No, you get
Are
earned income.
you talking about the earned income
Yeah,
credit?
yeah.
Oh, you're talking about the earned income credit.
Yeah.
But and then of course on New York State, if you're the non-custodial parent who is paying child support and you would qualify for the earned income credit, you would get the New York State non-custodial parent earned income credit too.
Correct.
Right?
Right.
Well, let's go to Larry. Hi, Larry.
Hello.
How are you, sir? What can we help you with?
Well, I'm stupid, but
You're not stupid.
I just retired, and I'm collecting my first year of pension and my first year of Social Security. And I had 10% taken out on my pension because I knew that was taxable. And it more than covered me. I had money coming back. But when I got my IRS statement, and then they told me to combine the two, I ended up owing the IRS $1,000. And I always thought that the only way you would be in that position is if you worked a job.
No. All right, let me ask you this, Larry. How much is your pension?
My pension minus the 10% is 17.
No. How much is your pension? Not minus the 10%. The whole thing.
$1,900 a month.
A month, right?
Right.
All right. And then, and are you married?
Yes, but I file separately.
Okay, so here's the thing. Do you live with your wife?
Yes, I do.
So why is there any reason why the two of you don't file a joint return?
Well, she still works.
Okay. Well, here's the thing. 85% of your Social Security is taxable if you're married filing a separate return. In most cases, you're going to find that you save money by filing a joint return, unless there's something unusual like large medical bills or large business expenses. So what I'd suggest you and your wife do is get together and see how much more you would save by filing a joint return. And you can fix it and send it in right now.
Yeah. See,
and
what Esther's saying is, if you're married filing separate, 85% of your Social Security is taxable, where that might not occur if you do married filing joint.
Okay. Now the other thing is that as I get older, does that amount decrease?
Nope. So far, I mean, we don't know what's going to happen under tax reform or if there's going to be tax reform. But when you're married filing a joint return, if half of your Social Security is added to your other income and it exceeds $32,000, then half of that is taxable until it gets to 28%. So that's been the law of the land for a long time.
You'll have a higher standard deduction once
That's
you're
right.
over the age of 65.
Larry, how much does your wife make?
To be honest with you, she hasn't worked in the last year. She's been on.
Oh my God! And you guys aren't filing a joint return?
No, I filed separately.
Oh, Larry, you got to fix your return.
And fix last year's.
And fix it, because she's you're going to get you're going to get a higher standard deduction. You're going to get her $4,050 personal exemption, and you're not going to pay 85% on your Social Security. So off the top of my head, it looks like thousands of dollars that you're going to
and
save.
amend 13 before
Right.
April 15th.
Oh boy, I messed up.
You did,
allowed.
and it's your money, right?
Oh,
So,
it is.
so give us a call. We'll be very happy to help you, Larry. Okay?
Well, thank you, ladies, very much.
All right, thank you. I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on the cell phone. You know, and it's so sad, isn't it, Tiff, that that's what happens? Because in this situation, he's got instead of getting the $12,000 standard deduction, 12.6,
Right.
he's only got $6,300. He'd only took his own personal exemption, so he's got $10,500, let's say, in deductions. But he should have the 12.6 plus the 8,000, so he should have almost 21,000.
And probably it all came to fruition this year when he did it, because all of his Social Security became taxable.
And his social and his pension is like 22,000. So that means all of that would have been taxable is only $2,000, which means his tax liability would be $200. And so he said he ended up owing $1,000. I'll bet you that he's going to get like $1,500 back.
That's pretty cool.
That is pretty cool. Why don't we go to Mary Ellen? Hey, Mary Ellen.
Yes, good afternoon.
Good afternoon.
For helping us with this calamity. Wondering, is there a difference between the life estate that you just spoke of and putting the home into an irrevocable trust fund?
Okay, so here's the thing. If you put the house in an irrevocable trust, it means that that's it. That house belongs to the trust. Period. End of issue. Done. Okay?
Mm-hmm.
So that means that you have pretty much locked that puppy up and nobody can do anything with it until the terms of the trust are abided by. But you know, and the other thing is, if you put it in a trust, the basis would be determined upon if you gifted it to the trust. So that would mean that the original basis would would be the steering factor as opposed to the stepped up basis. So I think that a irrevocable trust would not be the way to go. A life estate would be the way to go.
Oh, okay. Now, with either one, do you lose that $250,000 exclusion?
What $250,000 exclusion?
When the house is sold.
Oh,
well, the minute you don't own it anymore, you lose it. So the minute that it goes into the trust, it no longer belongs to a human being. It belongs to a trust. Okay. So it's lost immediately. For those of you that don't know what she's talking about, when you sell a home and you're single, the first $250,000 is tax-free if you lived in the house 2 out of the last 5 years. If it goes into a trust, it no longer belongs to an individual. It belongs to the trust. So there is no exclusion.
And is that the same with the life estate?
No, on the life estate, most people, it goes to the heirs upon the death, and so the heirs would get a stepped-up basis, so the heirs aren't going to pay any taxes. The only person that is able to avail themselves of that $500,000 exclusion, or $250,000 if you're single, is the taxpayer. The minute you mess around with it and put it into a trust, it no longer belongs to the taxpayer.
Mm-hmm. Now, does the life estate also have a 5-year look-back period for Medicaid?
Anytime you mess around with an asset and you want the state to pick up your nursing home, there's a 5-year look-back.
Okay.
Okay?
Okay, mistake.
Okay, sweetie. Talk to you later.
Thanks.
All right, let's go back to the phones and talk to Mr. Bob in Cheektowaga. Hey, Bob.
Hi. I have a New York State pension and also a 457 deferred comp plan. And IRA distributions that I'm receiving.
Okay.
Now, I know the New York State pension is not taxable, exempt.
On the state, right.
Yes. And there's a $20,000 exemption for the deferred comp and the IRA.
Well, if the deferred comp is from New York entities, isn't it, Esther All?
Now, my question is, do I have to deduct my pension from that $20,000?
No. All right, so here it's taken as two different packages, okay? Your New York State pension is completely tax-free, okay?
Okay.
The other pensions and annuities you get in IRAs are limited to $20,000 per person per year. So if you get, let's say you have a pension of $10,000 from your 457 and $3,000 from your IRA, that's 13, and that's under 20, so the whole thing is going to be tax-free too.
Okay.
Okay?
Thank you very much.
You're welcome.
Okay.
Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, and I will tell you, during the week, if you are stumped and you have questions, you can go to our website at egtax.com. There's a little part on there, Ask the Tax Lady, and you can kind of click on there and write your question, and I'll answer you right back, because it's very difficult to get information from the Internal Revenue Service because they really aren't answering tax questions anymore. Other things, Tiff, I want to talk about is over-the-road truckers. That they aren't, many times when I do a tax return, I'll see that they didn't know to take the 80% if they're a DOT worker when they're on the road for their travel and their meals.
Right, because most people on the 2106 only get 50%, but truckers over the road are special. They're Department of Transportation, so they get the 80%.
80% is a write-off. That's a big deal, because many a times these guys are over the road for 200 days, and you're figuring almost $50 a day. That's a $10,000 deduction. At 50%, you'd only get 5. At 80%, you get 8,000. So you want to make sure if you're a over-the-road trucker that you're doing the 80% on your 2106. The other thing we've kind of alluded to today is the IRAs, using that IRA to your best ability. Like, for instance, not only can you get the deduction if you contribute to an IRA up till April the 15th, but sometimes you get the pension savers credit too.
That's right, which is a double blessing. And then if you, like I said before, if you get health insurance through the marketplace, that could essentially increase your net premium tax credit too.
Okay, let's quickly go to one more caller before we wrap up the show. Hi, I'm Esther Golias. How can I help you? Hello? Hello?
Oh,
I guess.
Wait, here's another one. Here it is. Let's try this one.
Hello? Okay. Well, anyway, we don't have the call, Tip?
Hello?
Hello?
Hi. I'm calling about the energy credits for residential property.
Okay.
Is that only for your principal residence, or is it applicable to, say, like an income?
Nope, only personal residences. And I will tell you, 2016 was the last year for them.
Yes.
Okay, but it has to be your personal residence.
Anything to reduce or eliminate heat loss.
Pretty much.
Yeah.
And it's Energy Star.
All right. Thank you.
Thank you, dear. One of the big things, though, that are continuing over for, I think, one more year is the solar the solar credits, the geothermal credits, which are gigantic credits on the federal and the state, and that's still in effect. And of course, we really don't know what's going to happen with tax laws, because I was really stunned yesterday when I saw that the ACA was not defeated. So it'll be interesting to see what they're going to do with the tax law. And that's one of the reasons you want to listen to Ask the Tax Lady, because believe me, as it happens, we will let you know. And the other thing, the last thing I want to talk about, if you owe taxes, what not to do. A lot of times when people owe taxes, they don't file their return. Not a good idea, because one of the biggest biggest penalties they give you is a failure to file your return penalty. And so you want to get your return filed even if you owe money, and then you can set up a payment program.
Yeah, electronically. I've been doing this for several of my clients if it fits for them. There's a 9465, and you can do an installment agreement with your e-file return, and it's really fast, easy, and convenient.
Right. Okay. I'm Esther Gillies, the Tax Lady. Give EG Tax a call. Give us a try. We want to help you. Have a great week.